Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. A new funding round in the works at Anthropic. Sources tell Bloomberg that the AI giant could be valued at $900 billion. Plus, Honeywell CEO Vimal Kapur discusses his company's restructuring, a big split at a time when many companies are combining. And later, we'll speak with Citigroup Global Chair of M&A, Christina Mohr. She's been part of some of the biggest deals in media. Yeah, you guessed it, Paramount and Warner Brothers Discovery. Let's start with the headline we just received in the past hour. ARM Holdings and its majority owner Softbank made an approach to acquire Cerebras Systems. This headline comes as AI computing firm, that one specifically, is set to set its price, its IPO price later today. And Bloomberg's Bailey Lipschultz has been covering the IPO for us. And I guess, considering it's going to price, the offers came and they said, no, thank you, we'd rather be a public company.
They said no, thank you. It is interesting, Danny, because we reported last night that they're expected to price this above the marketed range. We're talking pre-dilution potentially around $35 billion. So a massive potential step up given what we may or may not have expected SoftBank to offer. But it does seem to be really the hottest deal in the market. And it's no surprise given the fact that over the last few months, the SOX is up, what, 55%?
That's exactly where I was going to go. This feels like maybe the perfect time to IPO considering what these types of AI chip companies have done.
Well, that's been the irony. Talking to investors and bankers, the company tried to go public a few years back, but was held up with a CFIUS review, its G42 contracts. And it's like, well, it did work out because you were going to raise a couple billion then, and now we're talking about the biggest deal from an IPO perspective this year and potentially markedly larger than ARM just a few years back. These are real dollars, and this is a big rally potentially for the stock and going to be one we're keeping a close eye on.
Yeah, super interested. So price today, trades tomorrow.
Yeah.
Okay, looking forward to continuing that conversation with you, Bailey. That is the Bloomberg reporter on IPO's Bailey Lipschultz. And another deal that we're watching in tech, Anthropic, in early talks with investors to raise at least $30 billion in a new round of financing. That would be its biggest ever raise. Bloomberg Tech co-anchor Ed Ludlow breaking this story for us, and he joins us now. And Ed, we also have to give you a shout out for that Cerebras breaking news, too, because you were also a scoop machine and on that one, too. So another funding round. I mean, it's crazy just how quickly Anthropic seems to be growing, both the company and its value.
Yeah, I mean, this is a story about the investors themselves being aggressive, knocking on Anthropic's door, sending them love letters and trying to convince them to do this round. You know, we've almost reported the week by week story where it went from Anthropic saying we're not interested in doing this to now being in a place where they are comfortable with the valuation. And I think we're talking above $900 billion, far beyond $900 billion, and raising capital $35 billion, maybe more. You know, that's the position that they are in, the strength that they have, but also it's quite telling of what's happening broadly in private markets, right? Yes, Cerebras IPO tomorrow, the biggest of the year so far, but the private markets are providing the capital that at the next level, that bigger scale, companies like Anthropic need, and Anthropic is doing it on terms that it is in control of.
Is there some element where in order for Anthropic to get comfortable with the valuations, they also need to be confident that they can command that type of market cap when they go public? Does that perhaps hold them back from accepting higher bids from some of the private community?
This is the fascinating dynamic. It depends which part of this race you track, right? Does it matter that if Anthropic were to close this round, and our understanding is it could close by the end of the month of May, they would have a valuation greater than OpenAI. We had reported that Anthropic looked at October for an IPO, but do they need to do that? And then, you know, you and I sat on stage together in New York City a couple of weeks ago. Everyone is just waiting for the SpaceX IPO in late June, early July, because does that suck the oxygen out the room, right? There is not infinite liquidity in a market where if you had 3 mega IPOs in a 6-month period, you know, your sort of corner and crossover investors are going to have to make a choice, I guess, especially where the stories are similar and analogous. So, you know, that is a big question. And it's really important sometimes to say we just don't know right now what Anthropic's thinking on that IPO is if this round gets closed in the private market.
And I've got a pitch to you. We need to do like a Bloomberg Tech Deals combo show when these big IPOs come, because it's going to be all anyone's talking
I don't want to
about.
get you in trouble with your EP, but get on a plane and let's do this on the road in San Francisco.
Ed, I will see you there. I mean, you said it on air, so it has to be official now. Ed, thank you so much for joining us. Bloomberg Tech co-anchor Ed Ludlow. And Bloomberg's Nora Melinda is here in New York City with an update on another developing story, eBay rejecting GameStop's takeover offer. Nora, the story of the century, perhaps, in deals. What do you have for us?
That's right, Danny. eBay is saying no to a massive takeover bid from GameStop CEO Ryan Cohen. The company's board rejected the roughly $56 billion offer, calling it, quote, neither credible nor attractive. eBay points to concerns over how the deal would be financed, potential operational risks, and questions around GameStop's governance. So for now, the answer is a clear no, but that may not be the end of the story. Cohen has already signaled that if the board shut him down, he could go the proxy fight route, essentially trying to win over shareholders and replace members of eBay's board. This would shift from a takeover attempt to a full-blown battle for control. eBay's currently standing firm, but this could be the start of a much longer battle for control.
Nora, thank you so much. Nora Melinda with the latest on eBay. There's also a story that we are following in the UK as shareholders are pushing for Intertek to engage in deal talks with private equity firm EQT. EQT has presented a fourth and final offer to acquire the company for about £60 per share. Crystal C joins us with more from London. So, Crystal, for our U.S. audience who maybe have not been following this, it feels like quite the story of intrigue, of EQT trying over and over. Activist investors are circling. What exactly is going on here?
Yeah, Danny, actually, this is the biggest corporate drama in London at the moment, where you have a private equity firm in Sweden, EQT, making a bid 4 times for the services company, Intertek. And in the mix of it, the company had rejected it 3 times, and multiple investors have vocally come out, some with letters, pretty strongly languaged letters, encouraging the company to to engage with this bid. And eventually, the latest development this morning here in London is that the companies has put out a release saying that they would be minded to recommend shareholders to engage in talks with EQT. So it's actually a couple of weeks in the making, and all of us have been watching it. So finally, the due diligence will begin, and we will see later on if the deal actually does happen.
There seems to be from Intertek, in terms of why they are pushing back. Is it essentially this idea like we can do it better ourselves? Maybe Intertek breaks up? I mean, why are they so resistant, Crystal?
Yeah, Intertek actually said this morning even that they still believe in their own standalone strategy. The company, though, actually had been undergoing a review and had talked about potentially separating the business. So in many ways, Intertek itself has sort of looking at a transition in its business strategy. So the other interesting thing here is we're actually seeing the investment banking world kind of is a battle of the grades right here, where you have Goldman and JP Morgan on one side and Morgan Stanley on the other side, as some of our peers have also pointed out. So all in all, it's just a wonderful corporate drama for London, and that has very, very strong shareholder involvement as well.
And this is why the deal stories and the PE stories are the best, Crystal, because this is what just like a testing and inspection company. Who knew it could be so exciting? Crystal C, live from our London bureau. Thank you so much. Elsewhere, we are following some personnel moves made by JP Morgan and their investment bank. According to memos, 2 staff seen by Bloomberg News, Dorothy Blessing, Kevin Foley, and Jared Kay, were named co-heads of the firm's global investment banking business. As part of an overhaul of the division's upper ranks, Anu Iyengar is being replaced as the bank's global head of M&A. She's been named a global chair in the division, and she just spoke with me last week at Milken about companies pushing for deals even in the face of uncertainty.
What we always tell boards and CEOs is, don't think about what does this mean for today's stock price the day after you announce it. Think about it as what is this going to do for your company for the next 5, 10, 20 years.
Coming up on the show, I ask Honeywell CEO Vimal Kapur about his company's massive restructuring. The big picture up next, right here on Bloomberg Deals. It's been a moment for mega mergers trying to get ahead while the regulatory environment is friendly, but Honeywell is moving in the opposite direction. Last year, it began a major restructuring to split into 3 separate companies. For a look at the big picture this week, I spoke with the CEO of the industrial giant Honeywell, Vimal Kapur.
We strongly believe that we have a strong set of capability as a company in Honeywell, but individual segments will perform better if we are a standalone company in specialty chemicals, in aerospace and automation. And that thesis is coming out true. We spun off our spec chem business in October of last year. It's doing extremely well. The aerospace separation will occur in about another 45 days' time. I'm very confident that aerospace is going to be one of the best-in-class aerospace, both operating company and stock, and so is automation. So our scale allowed us to create 3 large-scale companies. So I think our position is coming from a very different set of circumstances compared to others.
And can I just say, you were thrust into this whole thing. You and I were just talking about this moments ago. So you started in 2023. Mm-hmm. The process kicks off late 2024. Mm-hmm. And as you're doing this, by the way, every disruption that could possibly happen in the world is also happening, between supply chains getting rewritten, between AI scares, war in the Middle East now. How was it, just from a leadership portfolio, not only leading the spin-off and corporate transformation, but just all these existential issues happening in the world right now?
I think I kind of separate the two. We took on the journey that we need to separate into 3 companies. We started that process, you said it right, in early 24. And then we started announcing it one at a time. But at the same time, external disruption becomes part of how you operate as a company. And that's where maturity of companies like Honeywell come in, because we have built operating capabilities over decades. Those operating capabilities allow us to deal with this disruption, which was COVID in 2020. Then there was a chip shortages. Now there is a war. There's a Ukraine war. There's an Iran war. You are absolutely right. Each of them create a period of uncertainty into our operations wherever they get impacted. But thankfully, a company like us have a strong capability over a period of time that we know how to deal with it, both in terms of our people capability, our global scale. And someone like me, I would say we are kind of used to it. I wish there is a time in which there's no disruption. But for whatever, things keep happening all the time.
It is certainly the world we're living in, and as frightening and upsetting as some of it might be, there's also an element where it feels like Honeywell has a role to play. I mean, whether it be, aerospace, for example, huge amounts of CapEx because of what's happening in the digital economy. Did it change at all the timeline for some of these deals to get done?
Actually, I would say the timeline was more driven by ability to do this separation, right? So because it's a finite amount of time, you have to create legal entities, you have to do physical separation of the offices and IT systems. So most of the time is more determined by this act of performing the task. And none of our strategic plans have changed because of external factors. In fact, if anything, compared to 2 years back when we started doing this work, I feel more compelled that each of these businesses are going to do even better. Aerospace cycle is even stronger. When we made a decision, there was a Ukraine war already, but the Iran war hadn't occurred at that time. So now that generates the defense-related demand into our business because we serve that sector too. And when I come to the automation business, AI was not this prominent play for automation companies, but increasingly, as an automation business, we generate a lot of data. That data can be used to make our customers more productive. So as the data science is becoming more mature and we have ability to buy offering from likes of NVIDIA and Google to ingest into our product, that's creating additional set of opportunity for us in our business. So actually, where we started from versus where we are today, our net opportunity set has actually increased. So our decision is actually even more compelling compared to when we started this whole journey.
Is there anywhere where customers, because I mean, it's a lot of opportunity, but a lot of uncertainty too. Is there anywhere where they've kind of pulled back because of that uncertainty?
I think long-term decisions, absolutely not. Actually, there's a unique phenomena that long cycle orders for companies like Honeywell, or for that matter, many of our peer companies, the backlog keeps growing to a bigger and bigger number. In some of our businesses, for example, we have a big business for liquefaction of gas to make LNG. So 2/3 of the global LNG is made by our technology. That business is booked for next 3 or 4 years. So there are long cycle businesses where customers are actually moving their demand upwards, whether it is generation of power, producing of LNG, building of data centers, and we all know about the news. And that trend is actually coming even to some of our short cycle businesses, where typically our delivery times are 4, 6, 8 weeks. But we also see customers pulling forward their demand due to fear of inflation. Some can be fearful about, worried about shortage of products because of semiconductor. So I would say generally the demand has been very stable, but there is more pull forward of the demand due to uncertainty which the markets are creating at this point of time.
So you're talking about, you feel even more conviction about the three-way split and the strategy you have going forward. There's this narrative very much so that Elliott really fueled this by coming in with their investment, the activist investor. To what degree are they still involved in things like strategy and dictating timelines?
So our relationship with Elliott is quite unique. We treat them as one of our big investors because we are a public company which is owned by multiple large investors, and they being one of them. And I would say our engagement with them have been very productive and collaborative. I would say that bringing in an expertise of capital market becomes an additional input for us for making our different decisions. And we have to make our decision in the best interest of our shareholder and customer, but getting that insight of somebody who plays in capital markets every day becomes a very important data point for us.
So some of the details of the strategy going forward, for example, once the aerospace split is done, might you consider, for example, beefing up some of the building automation segment with various, AI-related acquisitions?
Yeah.
It's something that your competitors have done. Have you thought about that?
So in the RemainCo, in the automation business, we serve 3 big end markets, buildings of all types. So think of buildings like schools and airports and pharmaceutical facilities. Then industrial sector, which is semiconductor, utilities, facility, and then finally process industry, which is primarily energy sector. Now, our acquisitions will be how do we grow our capabilities in each, specifically where the growth is higher over the next many years. So if you see our trend of our acquisition over the last 2 years, we either acquired in end markets where the growth is very compelling, like LNG, we made 2 acquisitions there, or there is a technology trend which is irreversible, people spending more money on security. So we made acquisition for physical security, for cybersecurity. So that trend will basically persist, that we will make our acquisitions which are bolt-on. We don't do transformational acquisitions.
Our thanks again to Vimal Kapur, CEO of Honeywell, and you can watch the entirety of that conversation on Bloomberg.com and of course, on the terminal. You are watching Bloomberg Deals.
I'm Nora Melinda. Let's take a look at your midday movers. First up, the S&P 500 and NASDAQ 100 are both climbing as dip buyers step back in. Investors are largely looking past rising cost pressures after another hot inflation print and an ongoing war. Traders are using the recent pullback as an opportunity to snap up chipmaker stocks and other profit-generating tech names. Meanwhile, oil markets are retreating. Brent crude is easing back to around $106 a barrel, while WTI slips near 101. That resilience in U.S. prices comes as inventories dropped by about 4.3 million barrels, excluding SPR releases, and exports climbing to roughly 5.5 million barrels a day. And finally, Anduril Industries is commanding a hefty valuation, now pegged at $61 billion, in a new $5 billion funding round led by Thrive Capital and Andreessen Horowitz. Anduril, the defense tech firm, says it plans to invest aggressively in manufacturing, R&D, and infrastructure. The company's CEO spoke with Bloomberg Tech earlier.
As a business, we're entering this period where production is the name of the game. So the vast majority of our capital goes to scaling our factories, building out our production workforce, funding all that inventory, and really just getting that ramp to production working. And we're increasing production revenue something like 250%. Over the year, just year over year. So just a huge ramp in what we're seeing in terms of demand for our technology.
Those are your midday movers. I'm Nora Melinda.
Time now for an alternative view, and a new study from the Chicago Fed shows that life insurance companies owned by private capital firms have been piling into higher yield alternative credit, with placements from asset-backed securities and financial borrowers surging from 2 to 8% between 2017 and 2024. Bloomberg's Emily Grafeo wrote this story on the study and joins me now. Emily, I guess at first glance, it's like, well, of course, PE buys an insurer and then puts more insurance assets into private capital type investments. So why do we care? Why did they take a look at this specifically?
Well, so they took a look at this specifically because there's actually not a lot of work about, studies on the actual holdings of life insurance firms writ large. We know that since like almost 100 years ago, life insurance firms have been investing in private placements, a type of private credit, you could call it, that's typically investment grade. It's not registered with the SEC, so it's a little bit more in the dark than just a public bond, for example. But this study specifically singles out a rise in a very specific kind of private placement that specifically insurers backed by private capital firms, Apollo, KKR, just to name a few, are now investing in. So just in the last few years, you could see on that chart that was just pulled up, they've increased their holdings in ABS private placements and financial private placements, and they've done it at a faster pace than those insurance firms that aren't owned by these alternative asset managers.
Right. I was just speaking with the Mass Mutual CEO at Milken, and he basically was like, look, we've been doing this kind of stuff since the 1800s. Right. But you note in this study that they say, look, this increases the liquidity risks. Why do we care about the liquidity risk? Because isn't this presumably stuff people hold for like 100 years anyway? Does the timeline really, is the duration really a problem?
Yeah, no, it's a good point. And the authors definitely note in this study that, look, this is a limited set of data. We're only looking at, the last decade or so. However, I think they're more just raising a flag here that these kinds of private placements are a little bit more intermingled with the broader financial system. So instead of an insurance company lending for the long term to an infrastructure company, a utilities company, we're now seeing that they're more lending to another financial firm that then does lending. So think, a private credit firm itself. So the researchers here are kind of just flagging that, we're not saying that there's a risk right now, but that it's something to keep an eye on. Right. That potentially we could see a broader spillover if there is a broader credit crunch.
It feels like something that also might get the eye of regulators. They're already paying attention to private credit more, it feels like, in the latest sort of concerns about headlines.
Yeah, exactly. And I think we're going to see more alternative asset managers scoop up insurance assets. So again, it's just something to watch here of like, how exactly are they changing the investments? They had flagged two interesting ones. One of them, I don't know if people know this, the NBA, they borrow in private placements. So via Hardwood Funding LLC, that's their kind of league-wide credit facility. So fun fact there that insurance firms are actually lending to the NBA.
I love that because, if you have an insurance policy, like little do you know you're backing like the hot NBA asset. Emily, such a great story. I really recommend everyone go out and read it. That is, of course, Bloomberg's Emily Grafeo. Up next, our investment committee takes a closer look at the media industry following Paramount and Warner Brothers Discovery earnings last week. We get the perspective from Ian Nussbaum and Christina Mohr. This is Bloomberg. Welcome back to Bloomberg Deals. I'm Danny Berger. Last week saw some of the media giants report earnings. That includes Paramount and Warner Brothers, though fair to say that all those numbers were overshadowed by their pending deal together. Speaking of media, I also caught up with the Star CEO Jeffrey Hirsch, also following their results earlier this week about the consolidation of the media industry.
I think the stronger the broad-based players are, and if you look at the natural evolution of the space, you had cable companies and satellite companies, and now you have content companies becoming distribution platforms. And so the more the Warner Brothers and Paramount are stronger to compete with the Amazons, to compete with the Netflixes, with the Hulus and the Disneys, it gives us a great platform to be sold on top of.
And that brings us to this week's Investment Committee, where we take you into the boardroom debates in real time. Today's IC, Media M&A, and our committee members. It is the one and only Bloomberg Deals reporter, Michelle Davis, as well as Ian Nussbaum, M&A partner at Latham Watkins, and Christina Mohr, global chair of M&A at Citigroup, both of whom advise Paramount in the fight for Warner Brothers and countless other deals. Thank you all so much for joining. Christina, let me start with you, okay? Let's say this deal is done. What does it change about the media landscape now to have these two behemoths come together?
Well, first, thank you for having me, and it's a great question. I think that, as you know, the media industry has been in a process of transformation for decades, and this is really the most recent chapter. I think that you'll see, following this transaction, I think you'll see more pressure on the studios to continue to think about consolidation, given the profound amount of synergies in transactions such as this, and of course the scarcity value of the remaining studios. I think you'll also see consolidation amongst the streaming platforms, in particular now that we have three large dominant streamers among the streaming platforms. You'll continue to see the restructuring of the linear networks, and in particular the linear bundle and packages. You've seen that, obviously, a first step in the Versant transaction, which began to take a step toward that restructuring. And then, of course, you'll continue to see, for the entire video landscape, you'll continue to see the advent of more short form video relative to the existing longer form video.
I'm going to be honest, I hear you and I'm just like, okay, so the two of you are going to be even more busy now. I mean, Ian, would you largely agree with that?
Yeah, thanks for having me as well. And when I step back and look at it, there's also a theme that I've seen where there's also a little bit of back to the future going on, where you've seen a return to movie theaters. We're seeing 45 to 60-day windows now. Even had Netflix announce that they're going to release Greta Gerwig's The Chronicles of Narnia. IMAX has had a great banner year in 2025, and Live Nation also had great earnings. And so what we're seeing here is that there's also this kind of looking back and realizing that if you want to have your IP and you want to create that and where there's tremendous value, there's also, for a long time, been, you can have streaming anywhere, anytime. But I think people are starting to notice that having something specific at a specific point in time also creates a lot of value. So it's a really interesting inflection point right now.
And Christina, going back to this idea that scale obviously matters right now, across M&A, but especially in media entertainment, for the companies that are left, the distributors, the streamers, I mean, are there options to combine to survive, or do some of them disappear? I know you said there's going to be consolidation, but how do you see it kind of taking shape?
Well, I certainly think that we will see consolidation amongst the studios. I certainly think that we'll see consolidation amongst some of the linear networks and the linear platforms. With respect to the streamers, I think there are some questions around what the evolution of that streaming landscape will be. I think we all, for example, Netflix, which is the leading streamer in the United States, streaming platform in the United States, really, while it's the leading platform, it only accounts for about 10% of time watched. And so the real question with respect to some of the streaming platforms will be what's next, and in particular, what's next on the short form side.
On the linear side, Christina, might we not even see more mergers, but companies trying to spin out their linear TV, kind of saying, casting the problem child aside?
Well, for an M&A professional such as myself, spinoffs count as transactions too. So yes, I think you'll see the continued changes in this landscape and amongst the participants.
I want to talk about sports a little bit with you, Ian, because it feels like every other week there's a new record being set for valuations. Just a couple weeks ago, the San Diego Padres, of course, set a record in MLB. How long can this last? Is there a limit to how high valuations can get?
There's probably some limit, but obviously this kind of ties back into what I was saying of there's this real demand for experiences. Live sports fits in really nicely into that. Over the last 10 years, I think we've seen sports really come into its own asset class, with institutional investors coming into the space as well, with sponsors. And so I think you will continue to see valuations, and the Padres was really a positive sign from the market about the new media rights deals for baseball, because I think people don't see investing in sports teams anymore as just some sort of like trophy asset, that there's really a larger ecosystem that they're operating in around the brand and the IP as well.
Can I just push back on that, because the GPs themselves might feel that way, but it feels like LPs. I mean, I'm thinking of Clear Lake, who are like, what are you guys doing bidding on sports? Concentrate on the actual portfolio. I mean, is there still this idea that it's just a trophy asset and maybe distracting investors over other assets?
No, I think as you've seen the trades happen and the valuations go up, and there's economic backings to that within the media rights deal. As Christina mentioned, this really is a very scarce asset, and the media rights that we've seen, and as streamers have figured out how to incorporate sports streaming into their platforms over the last few years, you've seen those media right deals and the valuations go up. And I think there's a larger ecosystem. I think there is really a buildup around live experiences, especially in the age of AI and your phone, where you could watch everything in your sweats. But I think people have come out of this and really said, hey, it's nice to get dressed up and go somewhere.
On that AI point, it feels like there's a debate about kind of how it will impact the media industry. On the one hand, you could say it'll be bad because it'll commoditize content. On the other hand, if everyone loses their jobs, they'll have a lot more time to, watch TV and consume content. Christina, I mean, is there an M&A angle on the AI discussion for media?
Well, certainly from Ian and my perspective, there's always an M&A angle.
For everything.
Let's be clear. But no, I think that the AI, frankly, reinforces the value of quality IP, some of the existing IP. It actually has put a premium around some of the libraries of the major studios and even some of the smaller studios that exist. So AI has been very good for the intellectual property side of the business, and we think it will continue to be so.
Ian, would you agree with that?
I do, and I think over the last few years in particular, we've gone from AI might take over the world into AI as more of a tool. So a couple examples that come to mind is even in the music industry, I think there was a lot of thought around AI was going to develop and be successful and we are not going to need artists anymore. That hasn't proved to be true. They've created single hits, but they haven't created like a durable AI machine. And so I think people are understanding that AI can be a really enhancing tool, but there is something really human about authenticity, originality, and I have a young kid and I'm a dad, I make corny jokes, but I kind of say, like AI might be able to auto-complete your sentence, but it's not gonna auto-complete your soul.
Oh, wow, it could probably generate some corny jokes, though, I have to say. It could probably do well at that. I mean, Christina, okay, so AI makes IP more attractive, but as AI gets better and it does better things than just, completing sentences, is there a world where it is really transformational, that deals do look different just because it gets advanced and it reaches the level which it can replace, original content and IP?
Certainly, there's a possibility that AI-generated content could, in certain circumstances, compete with some of the existing long-form content. Certainly, you see it in short-form content at this point now. I think the jury's still out as to whether or not it actually creates real long-form content that is welcomed and embraced by audiences, and whether that actually becomes more competitive over time. Certainly there's the one thing I think we can guarantee, having done this for a long time, is there's a market for almost everything. The question is, where's the premium market?
Shifting gears a little bit, I mean, when you think about the regulatory landscape, Ian, how concerned are your clients about the dynamic we've seen where like state AGs are playing a bigger role in trying to police M&A? I'm thinking of the broadcast deal that's obviously held up right now. Is it giving anyone pause?
At a 30,000-foot level for any sophisticated M&A transaction, you are going to have regulatory on your mind for sure. And most deals these days, they're not really just local, they're global. So Latham, for example, is purpose-built because you need to have a complete regulatory strategy for any high-profile M&A transaction. So we're always top of mind thinking about how do you manage that process? How do you best execute that transaction seamlessly? Because it's not just going to be here in the United States, it's going to be globally and around the world.
And unfortunately, we're out of time. We're going to have to end it there. This has been such a pleasure to have you both. Thank you so much for joining. And that is today's investment committee, of course, Michelle Davis from Bloomberg, Ian Nussbaum with Latham, and Christina Mohr with Citi. Up next, we're speaking with TPG's David Trujillo about the firm's deal to help OpenAI launch its latest business entity. That's coming up next, right here on Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. OpenAI this week unveiled a new consulting and services business aimed at driving higher adoption of its technology across companies. The new joint venture is backed by billions of private equity dollars and led by PE powerhouse TPG. Joining us now, I'm pleased to say, is David Trujillo, partner at TPG, who's overseeing the effort. David, thank you so much for joining.
Thanks, Sam.
And look, this is such a cool deal because not only, are you a JV in this joint company, but it also means all your portfolio companies get access to OpenAI engineers, to the latest models, but it feels very, I guess, like a non-traditional PE type investment. I know you're very familiar, considering your background, with non-traditional PE investments, but how should we be thinking about where this strategy kind of fits into the overall TPG landscape?
Well, look, one of the things we distinguish ourselves, I think, relative to our peer set is our ability to work with strategics and do corporate partnership deals, carve-outs. I think we've done a couple dozen of these types of deals over the past 10 years or so. And look, we partnered with the likes of Intel, Syncora, Humana, United Health Group, AT&T. And so this, from a corporate partnership standpoint, is not very dissimilar from what we normally do. And then for us, we also do have investments in the model companies, OpenAI, Anthropic, others. And so have seen firsthand the dramatic growth of these foundational models. And stepping back, I think one of the things we've realized is that these models have progressed far beyond enterprise ability to know how to use them just yet. And with Deployco, we're trying to bridge that gap.
Are there exclusivity rights? Can you only use OpenAI now after this? And the reason I ask is because it feels like a horse race every day of like who has the better model, Anthropic, OpenAI. So does this mean you essentially hitch your wagon to OpenAI?
The short answer is no. That being said, we obviously are incented for Deployco to succeed. But at the end of the day, we're fiduciaries for all of our portfolio companies. They have the ability to make the decision in partnership with us as to which model, which service providers work best for them. That being said, in partnering with OpenAI and seeing their growth over time, we obviously think they're going to be one of the winners in the enterprise, and that this is very strategic for us, in addition to being a great investment.
There's also just been some reporting, again, just kind of the structure of this deal, that they've, essentially guaranteed a specific return, 17.5% was something thrown out there. Was there some sort of arrangement like that to get you comfortable with this deal?
Yeah, we haven't publicly commented on the terms of the deal. We never do.
I had to try to get it out of you, David.
But, as I said, I think this is, it's a very kind of standard corporate partnership for us, where OpenAI is going to control it. We're going to have a very healthy balance sheet, starting with $4 billion of injected capital. That's going to give us the ability to look at M&A, as we've already announced, also hiring new FDEs for deployed engineers, and other organic and inorganic growth initiatives.
TPG has a huge portfolio, 400 plus companies, and it's not like you have a lot of software companies that, you come in and need to transform with AI. In fact, you have a lot of exposure to services companies, for example. So when you look through the portfolio, how do you decide where it makes sense to have those forward deployment engineers come in to try to transform these companies towards a more AI lens?
Yeah, it's a really good question. We've been around this space for quite a while, even in advance of ChatGPT. We'd invested in data businesses, machine learning businesses, and so there was a lot of pattern recognition for us. Initially, when ChatGPT did come out, I think we, as many private equity firms, thought, okay, defensively, where are we at risk within the portfolio? Then we quickly pivoted to offensively, where can we deploy these tools? And I think, in our portfolio, we've seen early wins across customer service, for instance, in terms of getting efficiencies there, also improving the efficiency of our engineers. And when you think of the technology, it has the ability on these algorithms or autofill of, when you think of a customer service decision tree as to what do I do next when the customer says X, I do Y, these models are incredibly capable in that regard. I think what we've moved to now, though, is in our own business, beyond just the defensive and offensive within the portfolio, is starting to think about using these models to totally transform companies and incorporating them into our underwrite. And so recently, we acquired a utility services business that deals with millions and millions of customer bills. 1 in 5 utility bills has an error to it. We have to allocate them on a unit-by-unit basis. And in underwriting that deal, we thought, this type of process, where it's very people intensive and outside system intensive, where you're trying to verify these bills and get to accurate billings by unit, we could incorporate these technologies to improve that workflow dramatically. And we're underwriting a lot of savings coming out of that.
It's certainly interesting, because it's not a company you typically first think, oh yeah, AI could do something here. This deal, though, too, not only with the OpenAI sort of club deal with, Bain, some of your competitors are in it, you also have one for Anthropic, too. What becomes your edge when all of your big competitors have access to the same technology?
Yeah, look, I think it's just getting close to the technology because this is very new. And stepping back, for us within our portfolio, we have over 300 companies. All of our CEOs are clamoring to deploy these tools. And one of the things when you're dealing with 40, 50, 60-year-old executive teams on average, they don't have a lot of experience using these foundational models.
Wait, just by the way, on that, because I talked to an executive who was like, everyone wants to bury their head in the sand. What do you think is different about some of the companies that you work with that they've been so willing and wanting to adopt some of this technology?
I think part of it is our approach. We tend to invest in more growthful businesses and more growthful management teams with a more growthful mindset. And they're literally looking at these tools to say, hey, where can I get efficiencies and where can I use them to develop new products and services? The issue is they don't know where to start. And then take it a step further where the industry has grown so rapidly. And we, pattern recognition as investors, if you think of the software industry, when Oracle was being developed or SAP or Salesforce, they were growing high growth at the time, but they had enough time to develop their own first-party services and starting to seed a third-party system of system integrators, whether it's the McKinseys, Bains, Accentures, Deloittes of the world. What's happened in AI is these models have grown so dramatically that we haven't had time to seed the ecosystem yet, or for OpenAI or Anthropic to seed their own first-party services. And so I think these partnerships are a way of catalyzing that so that we can bring these models, which in many cases are way more advanced than people know how to use them, to bridge that gap.
How are you thinking about cost? There was a story the other week that Uber essentially ran through all of its inference costs for the year in just a couple months. There's a story from the Information Today that Anthropic is starting to pass along those costs. Can your companies absorb the extra cost that it takes for inference? And perhaps we haven't even seen the large language models fully pass along the cost that it is anyway.
Yeah, I think there's a lot of experimental budgets taking place right now of people testing and trying and finding things that aren't working, things that are working. And we're in that very early stage. But we are starting to see, at least in our own portfolio, as I mentioned, in things like customer service, productivity of engineers, and other workflows that we can automate, we're starting to see that ROI. And so to us, it is going to be sticky.
Wait, does automation mean job cuts? I feel like sometimes people hear that and they're like, oh, less people.
I think there's this doomer scenario or narrative around AI that I personally don't fall in that camp. I think there is going to be some job displacement and ultimately new jobs created. But I'm always reminded, having been around these technology shifts for a while, whether it was the internet or mobile, take for instance autonomous driving. If you would have sat in San Francisco with me back in 2015, 2016, you would have read every report and thought, oh, autonomous driving is going to be tomorrow. Meanwhile, we sit here 10 years later, I think it's less than 1% of miles driven. The technology is there, it's inevitably coming, but these things take a longer time to play out in practical reality. And I think that's going to give us, and labor, to your point, a time to adjust to these new technologies.
Really excited to hear any updates. Again, such an interesting deal. Thank you so much for joining us.
Thank you.
The week of announcing it, that is David Trujillo, partner at TPG. Coming up, a very different story. Federal prosecutors accusing a group of M&A attorneys at some of the top firms of insider trading. We're going to discuss that next. This is Bloomberg Deals. This is Bloomberg Deals. I'm Danny Berger. A story that has rocked the M&A world. Elite lawyers have been accused of aiding a massive insider trading ring. The FBI says a network of 30 people shared tips and payoffs around the deals being managed by big law firms. Chris Dolmetsch covers legal matters for Bloomberg, and he joins us now. Chris, I guess just what are the details of the story? I mean, when it came out, when you were reporting on this earlier this week, I feel like it was read nonstop. There's so much intrigue here.
Yes, I mean, it's a very big ring. It has a lot of tentacles to it. It's, the top is some of lawyers at some of the biggest, M&A law firms in the country, Sidley Austin, Latham Watkins, Goodwin Procter, among a number of them, allegedly taking confidential information on deals. Some of the deals they didn't even work on, kind of viewing the information in the document management system in a rogue way and distributing it to former college, classmates, associates who passed it on to a bunch of other people, hairdressers, physicians. lots of different people were trading on this information. It likely a whole lot of whom didn't even know really where it was coming from.
Chris, I mean, have the law firm, and only about a minute here, but have these law firms taken a look inward? Because presumably there's a lot of systems in place to prevent this kind of thing.
Yeah, we don't, know exactly what they're doing now. One assumes that they're communicating with clients and the partners. I expect that'll happen over the next couple of weeks as it susses out. But they have all decried the behavior, said that, they've been cooperating with the prosecutors and that they're going to, that they let go of these people as soon as that there was a indication that they had, taken this information.
Right. Okay, Chris, thank you very much for joining us on that story. Bloomberg's Chris Vilmech. And that does it for Bloomberg Deals. To stay up to speed even after the show, subscribe to the Bloomberg Deals newsletter. That does it for us. Up next, Balance of Power live from Washington. This is Bloomberg.